and welcome to Market Domination Overtime. Stocks closing higher here for the second day in a row, and our very own Jared Blickery standing by with the headlines. Jared.
Thank you, Josh. Yeah, it's nice to see some risk on for the second day in a row. And as I said about an hour ago, a lot of these markets have caught up this week and are now facing positive territory. So almost as if that whole volatility episode from earlier in the week didn't happen. But of course it did. Let's check out the charts first and see what happened today. Maybe then we'll have time to go back and see what happened in the week. Here's the Dow. You can see off of the highs, well off the highs, but still up about 300 points or 0.6%. Here's the NASDAQ up almost 1%. And you can see also closing about 1/4 off of its highs there. And then S&P 500 up about 0.5% or 37 points. Also want to point out the Russell 2000 because the small caps have been outperforming this year, this week especially. And here's the Russell 2000 good for a record high, up 0.7%. And you can throw the S&P 600 in there as well. That was good for a record high. And you can even throw in the S&P 400. That just barely eked out a win, but that's good enough for a record closing high for the mid-cap dominated index. And I just want to check in on the VIX because I'm going to show you the 4-day view so you can see what was happening this week. We got a bit of a spike above 20 there. And let me just actually put the year to date. And there you can see that big spike. And we have come well down to the levels that preceded that kind of volatility scare earlier in the week when we had the Sell America vibe. So that is in the rearview mirror. That is good news for investors. And here's a 10-year T-note yield. I'm going to dial this down to an intraday chart. You can see just about flatline, barely red there, but closing in at 4.25%. 30-year down about 2 basis points to 4.85%. And just a reminder, I'll show you the year-to-date here. It was as high intraday as 4.95%. And so that was kind of spooking investors there. Higher, longer-term yields is kind of an expression that the Federal Reserve, maybe fiscal largesse, just kind of losing control of the situation. But nevertheless, 30-year coming in the right way, which is to the downside. Here's the U.S. dollar index. It is down year-to-date, and it is down today. And so that's also kind of a pressure release valve. What we saw earlier in the week when the dollar was sinking, we were also seeing bonds getting sold and also stocks getting sold. That was a precarious situation. That is not the case today when we have stocks up and the dollar down. So that's a much better correlation that we're looking at there, an inverse one at that. And let's check in on the sector action. The three leaders are, not surprisingly, the mega cap sectors. They have mounted a comeback. So it's not all the Russell 2000 and the small caps. So big guys have been winning today, at least. Communication services, that's where you're going to find Alphabet and Meta. That was up almost 1.5%. Then you got consumer discretionary. That's where you got Tesla and Amazon. That's up 1%. And then tech. We all know tech. That's Apple and Nvidia. Also, I mentioned financials. Financials, large cap up about 0.6%. And those four sectors are the only outperformers of the S&P 500, which I'm circling right here. To the downside, we got real estate, utilities, industrials, and staples. All of those underperforming and all of those in the red today. And here's a final look at the NASDAQ 100. I mentioned Tesla and Meta before. Meta up 5% at the bottom there, and Tesla up 4%. So that's really contributing to some of that mega cap strength that we're seeing there. And then if we take a look at the Dow closing figures, aside from the mega caps, we got a few red spots. Walmart and IBM each down 1%, Merck down almost 2%, but Procter & Gamble up over 2%, American Express over 2%, and Salesforce almost up 3%. And I'm going to send it back to you, Josh, there.
All right. Thank you, Jared. Time now to dig into some earnings. We're going to take a look at Intel as its fourth quarter results are just hitting the wire right now. Get you those reports. Q4 EPS, I'm looking for 15 cents. That looks like a beat. Q4 revenue, $13.67 billion versus an estimate of $13.43 billion. So that's a beat. Just looking through the segments quickly here. Data center and AI revenue for Q4 looks like $4.74 billion versus estimate of $4.42 billion. So that was like a beat. Client computing revenue, $8.19 billion versus estimate of $8.3 billion. So that's a bit light. Importantly, turning to the forecast here, Q1 adjusted EPS. For Q1, that looks like a miss versus a consensus. I'm just looking for Q1 revenue forecast. That's $11.7 to $12.7 billion. The street is at $12.56 billion. So initially here, off that print, you're down a quick 5%. Of course, remember the stock had been a rocket ship heading into this report. It was up more than 40% this year to date. It was up around 150% over the past 12 months heading into the print. So sentiment was positive. Analysts, I know, were talking about reasons for the move here into the print. They would talk about that 18A manufacturing process. They were talking about hopes for the foundry business, that chip manufacturing arm. They would point out the favor of the Trump administration toward Intel. That doesn't hurt. Looking ahead beyond the print, I think you're going to have a lot of questions about expectations for the PC shipments this year, expectations for the server market, any more color we may get about 18A yields and that foundry business. I know some of the street wondering where they may have to move up their CapEx plans. But initially here, off what looks to be some weak guidance, we see the stock down about 4% in the after hours. Well, for more on Intel's latest quarter results, let's now welcome in TECHnalysis Research President. That would be Bob O'Donnell. Initial thoughts here, Bob. They did just report. I see the stock's down about 3% here. What's your initial take on the print?
Well, I mean, look, obviously the forecast is a little lower than people were expecting. That's a bit disappointing. But I'm, just kind of quickly trying to scan through it there. It looks like there's a couple interesting things that, they're pointing out. They're talking about inventories being low. We know that in general, capacity across the semiconductor industry has been limited. So I'll be curious to see if there's more commentary in terms of, what they're saying about, the ability, their limitations in terms of what they're able to sell because of inventory. So that's something we're going to have to be aware of. Obviously, there's, if there is any color on foundry, I will say a couple things though, one of the things that's been leading, I think, to that big run-up that you were just talking about is this recognition that the server market across the board has been showing signs of strength. And I think one of the big things is sort of the psychological recognition that CPUs actually matter in AI compute, right? We've all been focused on the GPUs, and of course that continues to be a huge part of it. But as you get these more complex systems, CPUs become a really important part in terms of connecting with the networking and the storage, and because these systems are growing beyond a single rack to multiple racks, and then how that all gets handled becomes a big deal. And also, I think there's a comment in there from Zinsner about something about their ASIC business growing. So that's around networking chips. So that's an interesting sign. So, I think there's a couple interesting factors there. Will also be important to see what they say about general uptake of Panther Lake. I will say it was very well received at CES. Initial reviews of the systems look positive. So that's a good sign for 18A, which theoretically bleeds over into the foundry business as well.
So just give a bit more color on that forecast, Bob. First quarter revenue, 11.7 to 12.7. The midpoint of that range does fall short of the 12.6 that analysts had penciled in. And the company expects to break even in earnings per share ex certain items. The street had projected a profit of 8 cents. So there's your weakness. In terms of manufacturing yields, a bit more color there for you, Bob. CEO Lip Bhutan, it looks like, gave an interview to Bloomberg. Demand, he's saying, quite strong. Company's working hard to fix its manufacturing problems. He says, our yield and production manufacturing are not up to my standards, he said, and we need to improve that. What's your take on that color?
Well, I mean, obviously that would imply that you're not getting the capacity, the yields that they need, which means they don't have the supply that they need. So that could be a factor here in terms of what in terms of both their existing sales and then the forecast. If they don't have enough chips, even if the demand is there, they can only sell so many things. So, we'll have to definitely see what he has to say about that. I mean, 18A is an early process. It's their obviously most advanced process, puts them on the same level as TSMC in terms of technical manufacturing capabilities, but it's new. I will say they said at CES that they were surprised and pleasantly surprised they could launch all 3 versions of Panther Lake beforehand. So that would suggest that something is going right there. But, yield rates are those kind of numbers that we only hear about after the fact. So again, like you said, it'll be interesting to hear what he has to say. But if they can get that yield up, and obviously they've got to continue building out those server parts as quickly as they can, that's going to be important. The cloud that hangs over all this, unfortunately, is the DRAM stuff. Even though Intel doesn't use DRAM in their parts and obviously doesn't manufacture DRAM, you got to have DRAM to build PCs and servers. And so there is that question mark of how much of an impact will that DRAM cloud overhang, and is that impacting their forecast?
Yeah, just to add more color there, Tan saying here in that interview that Intel faces an execution challenge. We are laser focused as a team to improve that. He said, to be candid, it's just our execution needs to improve. Let me also ask you, obviously a key question for Intel, Bob, is just that PC market and how healthy, how resilient you think it's going to be. What do you think PC shipments are going to look like in 2026?
Well, look, if it wasn't for DRAM, I think PC shipments would be incredibly strong. The DRAM thing does raise a question mark. A couple things I will tell you. I did some research last fall on amongst enterprises on AI PCs, and even though the sales haven't been huge, people believe they're incredibly important because they expect this idea of hybrid AI, where you do AI both in the cloud and on the client, to grow, and I think that's going to drive a lot more growth in AI PCs. The other thing I will say, I had met with every single major PC vendor, with Dell, HP, Lenovo, all of these guys. They all had very positive things to say about Panther Lake. And to me, that's important too, because look, last year, Intel faced a lot of, big questions, sort of that philosophical question of, hey, can we rely on these guys? Can we trust these guys? And when I walked away from those meetings at CES, I was like, okay, Intel's back on track. They're figuring this out. Obviously, they're having some challenges that Lip-Bu's talking about. But I will say that their core customers in the PC business seemed much more confident in Intel than I've seen them, to be honest with you, in quite a while. So to me, that's a positive sign. How that translates into dollars and cents, obviously, it still is a question mark. But psychologically, I think that's an important barrier for them to overcome and gives them, I think, a positive sense moving forward.
Bob, as always, appreciate that instant analysis and insight. Thank you, sir.
Thanks, Josh.
Coming up, Bank of America and Citi reportedly considering new cards with 10% interest rates, according to Bloomberg. We get an expert's take on this move next on Market Domination Overtime. President Trump making waves in Davos this week, floating a cap to credit card interest rates at 10% for 1 year. JP Morgan Chase CEO Jamie Dimon then issuing a sharp warning against that cap.
It would be an economic disaster. And I'm not making up because our business, we would survive it, by the way. If you, in the worst case, you have a drastic reduction of the credit card business. I mean drastic. I mean like 10%. I mean like 80%. It would remove credit from 80% of Americans, and that is their backup credit.
Bank of America and Citigroup trying to find some neutral ground now, exploring options for cards with a 10% rate. That's according to Bloomberg. For more, we're bringing in Sheila Bair, former chair of the FDIC and author of How Not to Lose $1 Million. Sheila, it is great to see you. So let's start there. President Trump, we know he's zeroed in on this issue of affordability, like this temporary cap on credit card rates. Got a new Bloomberg report. They're citing sources, Sheila, saying that Bank of America and Citi thinking about offering cards with a 10% rate. What do you think, Sheila? Smart idea, smart policy?
Well, I think at 10% is a pretty low rate, but the rates they are now, the average is like 22.5%, is pretty ridiculous. And in point of fact, banks have kept credit card rates even high, even when the Fed was lowering rates to try to stimulate the economy. It wasn't trickling down. So I think there's a lot of room to cut there without having to withdraw credit. A lot of these doom and gloom arguments being made by banks are really based on their own kind of self-serving argument. Well, we're going to pull back, we're going to eliminate 80% of people or whatever from credit cards if we get this interest rate cap. So I think that's not well substantiated. There are studies, a Vanderbilt study that says even at 10%, they could serve the vast majority of their customers. So I think the truth lies somewhere in the middle, like most of these issues, but at least this has put a spotlight on how really high credit card rates are. Certainly historically, they're very high, and the questionable justifications that the banks are providing for keeping them that high.
It is interesting, Sheila. I mean, you're kind of hard-pressed to think of many areas where Donald Trump and Senator Elizabeth Warren can find agreement. But
right.
The good senator is there saying she wants a law passed to get a cap on credit card interest rates. She seems to dismiss these concerns that the big banks have brought up here. It is interesting where these two can find some common ground.
Right. Yeah, well, it's the populist left meeting the populist right. It's probably banking's worst nightmare. I mean, I think you're kind of seeing now that this administration is a mixed bag for banks. So they've gotten a lot of deregulation, a lot of it irresponsible deregulation, as far as I'm concerned. But now they're coming after them in different ways, and credit cards really are at the top of the list. It's a pain point for retailers. It's a pain point for consumers. So it's smart politics to go after them. But we've got this debanking lawsuit, crypto. There's a big fight between the banks and the crypto industry over how to regulate crypto, and that's all about relative competitive advantage to banks. The administration is clearly on the crypto industry side. So this is definitely a mixed bag, this administration for banks, and they've got their work cut out for them, I think, on some of these policy issues.
On that point, Trump and the relationship with big banks, the roller coaster there was this other big headline. I'm sure you saw this today. Trump now suing J.P. Morgan and CEO Jamie Dimon for at least $5 billion. Says the bank stopped offering him and his businesses banking services. He was debanked, in other words, allegedly for political reasons. J.P. Morgan is firing back, saying, "Listen, the suit has no merit." I mean, obviously, Dimon and Trump have a complicated relationship, goes back many years. What'd you make of that headline, that report, Sheila?
Yeah, I didn't know. I really don't know what the facts are. I thought the timing was curious. It's so long after the alleged charged debanking incident. So I'm not sure what to think about it. Debanking was carried too far with the prior administration. There's no doubt about it. It certainly is appropriate for supervisors to look at banking relationships. And if a bank's dealing with a very high-risk customer from a illicit financing or money laundering standpoint, there's going to be extra scrutiny on those accounts. Politically motivated debanking never should have been allowed. I don't know if it was going on or not. I take at face value that Chase says they don't do that, but we really don't know what the facts are that led to the termination of these counts. So I think we need more evidence and need to learn more about what happened. But the timing is strange. I thought it was interesting that it would be coming now.
More broadly, Sheila, I'd love just put your old FDIC hat back on and just get your take on where we are, the U.S. banking system, Sheila. I mean, obviously, listen, we heard from the big banks; they reported financial results. I think broadly they were strong, but obviously, just because you're beating on the bottom line, that doesn't tell the whole story. So I'm just curious to get your take. Like how healthy, how resilient are we, Sheila?
So I think the big banks at least, will have a very good year this year. They're already having a good year. So they've got deregulation, rates are going down, which, on the investment banking side of these large banks, they're doing quite well. Interest rates go down. The lending side is more of a mixed bag. But on the trading side and investment banking side, rates going down leads to deal activity, leads to bond issuance, leads to a lot of, inflated asset values. A lot of things, if you're an investment banker, a lot of good things come from lowering interest rates. So I think they're going to have a good year. I mean, longer term, I don't know how stable we are. Mr. Trump is really running this economy hot. We've got credit stimulus, we've got monetary stimulus, we've got fiscal stimulus, we've got tax cuts. It's coming at all sides. And, that works until it doesn't. And things are fine now, but things looked good prior to the financial crisis in 2008. And it was really just building up to a fairly significant, fall. So with the crash of the stock market, the housing market. So I hope that doesn't happen. Now everybody's worried about tech. Housing is inflated too. So we'll see where all this ends up. But I think, longer term, the risk that these highly inflated asset valuations, especially in the stock market, will correct, and how that impacts banking. Consumer spending is heavily driven now by the wealth effect of inflated stock portfolios. So the higher echelons of wealth are really driving consumer spending now. That's not the way it used to be. It used to be the middle and lower income people. But now it's the higher echelons, and that's being driven by these huge gains they've had in their stock portfolios. So if that comes crashing down, it could have a big hit on consumer spending and then a big hit on the economy. So if I were a banker worried about something right now, that would be it.
Sheila, we're always lucky to have you on the show. Thanks for your time today.
My pleasure. Thanks.
Well, the most nominated Oscar movie ever is now produced by Warner Brothers Discovery. Sinners, bagged 16 nominations, further casting eyes on WBD's prize studio assets amid a fierce bidding war. WBD today saying 93% of shareholders have rejected the, quote, inferior Paramount offer in favor of Netflix. This was in response to Paramount extending their offer deadline to mid-February. Brooke DePalma with me now. Brooke, what do you got?
So essentially what we heard from Paramount this morning in a filing is that, yes, they did extend their offer. Their offer now stands at $30 all cash offer, now is extended to February 20th. Prior to this, that offer was going to expire on January 21st, so essentially yesterday. And what I've heard from sources on the street is that this ultimately provides Paramount a bit more time. We could potentially hear a higher bid from Paramount for Warner Brothers. And also just buckle up because we don't know exactly what is coming next. It's really just extends this saga that we've already seen. But in a statement to Yahoo Finance from Warner Brothers, the company said that ultimately Paramount came back with the same offer. They went on to say that their board has repeatedly and unanimously rejected in favor of a superior merger agreement with Netflix. It's also clear our shareholders agree, with more than 93% also rejecting Paramount's inferior deal, or inferior scheme rather. And so what we're really seeing here is this saga continuing to build. Just this week, it feels like eons ago, but just this week, Netflix actually came back with a all cash offer. It formerly was cash and stock. Now that $27.75 offer is now all cash. And so really this continues. Even Paramount throwing some shade within this filing this morning, saying that the Netflix deal would materially entrench Netflix market dominance and give the company about 43% market share. Of course, there's some regulatory concern on the street as well.
Before I let you go, tell me more about these nominations. How did they break down among the film studios?
Well, this really kind of solidifies where Warner Brothers stands. They got the most Oscar nominations, a total of 30 Oscar nominations, led by Sinners, alongside One Battle After Another, alongside Weapons. And then you look at Netflix, they had about 18 nominations. And then alongside Disney, just 4. And so this really goes to show Netflix really wanting to lean further into the film business and really seeing how much this would solidify Netflix as a key player within the studio's business should this deal go through.
All right. Thank you, Brooke. Appreciate it. Time now for What to Watch Friday, January 23rd. It is the final day of the World Economic Forum in Davos, Switzerland. It has been a whirlwind week in the Swiss Alps, from President Trump's back and forth with European leaders on the future of Greenland to commentary on the economy and more from top business leaders, including Elon Musk, who made his first ever appearance in Davos Thursday. Turn to earnings. We're going to get some insight into the energy sector on Friday. SLB announcing results for the fourth quarter before the markets open. Analysts expecting a strong Q4 driven by its software and digital businesses, offsetting weakness in parts of the traditional oil field segment. Investors will also be looking for signals if the company will expand its operations in Venezuela, as the Trump administration is looking for American companies to take the lead in rebuilding Venezuela's oil industry. And taking a look at the consumer too, the final consumer sentiment reading for January, that's coming out on Friday. Economists forecasting that to hold steady at 54. And finally, tune in Friday for a deep dive on the housing market and our special Housing Crisis, the New Reality. Coverage starts at 4:30 p.m. Eastern. You won't want to miss it. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.